So here are our panelists. I want to introduce them briefly before we dive in. I don't want to spend the first half hour all in introductions because we got a lot to get to. But we have Sam Bachman. He's got deep roots in his family farm going back generations. He's also an analytics consultant at Uncommon Farms, which helps producers across North America take control of their legacy by helping them build profitable and sustainable operations, positioning them for multi-generational success. Also, we have Grant Weezy, who has 12 years of experience in ag lending. He comes from a family farm himself and now spends his days working with farmers to make optimal financial decisions. He also writes what I heard yesterday from another panelist, who I won't call out yet, call one of the best newsletters in all of agriculture. So that was really enticing to me. It caused me to subscribe myself last night. You can subscribe as well at farm640.com. Joining us as well is Shay Folk, who is an ag business consultant at AgView Solutions. Their team focuses on profit management, business structuring, transition planning, and farm professional development through peer group facilitation. They work with producers across the US and Canada in depth for their operational needs, as well as focusing on profit management through their profit manager system. And last but not least is Ben Gordon, CEO of Fractal Agriculture, which provides farmers with equity financing by investing alongside them in their farmland to fund their growth. I'm sure we're going to talk more about Fractal and how it fits in today's conversation by the end of today's session. But Ben's native of North Dakota, who's got a background with Granular and Corteva, as well as time in management consulting and with the U.S. Army National Guard. So super excited to talk to each of these folks. And I thought, we would just start by framing up this conversation about lower margins and high interest rates. What's the data showing us? And Sam has been kind enough to provide some of this information about what they're seeing at Uncommon Farms and what the data is telling us nationally. So Sam, I'm going to start by turning it over to you, and then we'll hop into the conversation together.
Excellent. Well, thank you, Tim. Thank you, everyone, for joining us today. It's good that people are tuning into this type of discussion. This finance is a very important aspect of a farm today. Let's go ahead and look at that first slide. And what we're seeing there is, why are we calling this word tight margin? Everybody knows this, and this is just a picture that I took courtesy of Bar Chart yesterday to look at what's going on with corn price. If you're like me, you have corn in the bin, and you're waiting for the price to get lower before you sell it. And maybe I'll sell it when it's 3 something. I don't know. But yesterday's move takes us down to a line of support. And then now we're all thinking about the very difficult time that we experienced back in 2014 and 15. Again, my name is Sam Bachman. I'm with Uncommon Farms. We are a farmer-owned farmer group with the intent of trying to help farmers control their legacy, that you would have control of your business. And this financial side of the business is one that I spend my time digging into. As a data analyst, I make a lot of pictures and try to help people then get a good feel for what's going on. But this picture is publicly available. The only thing I did with this picture was to make the vertical axis, the y-axis, logarithmic, to make it where you can see the percentage change. So $2 to $4 is the same doubling that you'd get when you went from $4 to $8. One of the challenges in this business is that your revenue can go from 8 to 4 in just 2 years. Other businesses don't have that phenomena. It really doesn't impact your cost structure, because coming in this direction off the highs is a very difficult profitability picture. We are not able to pencil out budgets that work here in 2024. It's a very difficult time to be in this portion of the cycle, as we've all experienced before. The challenge for us as farms trying to stay competitive is, how do you function in this environment? I guess it's good that we have that panel question right up front. 2/3 of us are deciding that maybe the time is to sit on the sideline. And strategically, that may be something that we want to rethink. Our goal here is to get you thinking about, how do we know where we're at so that we can continue to be competitive in times when others are scared. That's going to require that you have a good budget in place. And I think everybody on the panel today would be willing to help you with that. And likewise, that you have a good understanding of where you're at in terms of your balance sheet strength. So when we talk about tight margins, this picture says everything, and you already know this. Now, our next slide really answers the questions of high interest rate. Everybody on the call is busy. Maybe this was missed, but if you have gone to sit down with your banker recently, you know that rates are not what they were. But it's good to look a little deeper. We looked at a 20-year picture just previously there on pricing, and we see that that 20-year picture gives us a little insight in terms of the cycles. But here we're looking at a 60-year picture on interest rates. This is publicly available data. I just took this yesterday off the Federal Reserve system here out of St. Louis, Fred, they call it, and just Google it and pull up the GS10. This is a 10-year Treasury note. And what it tells you is really a shape of mortgage rates. The 30-year fixed, home mortgage rates, long-term mortgage rates mirror this picture. And as we see this, we see rates now all of a sudden at a point that we haven't seen for 15 years. Maybe, depending on how you read this chart, maybe it's at a point that we haven't seen for 50 or 60 years. And this is significant because it is your cost of capital. Farms are capital intensive businesses, and the cost of capital dictates limits some of what you can do. And one of the things that I like to highlight for people is that it has been a 40-year trend since 1980 of bailing bad decisions out. As rates fall, as they've been since 1980, any of the mistakes that are made, you tend to be able to bail yourself out because rates just got cheaper and cheaper and cheaper. I've often talked to people about some of the psychological pitfalls that come with being in business. I've been doing this for 40 years and I know how it works. Well, no, it's actually all of a sudden a different game than it has been for the last 40 years. Maybe a game that's closer to what your grandfather had to deal with, or maybe your dad had to deal with. Recognizing that is important. These 11 rate hikes that happened here over the last 20 months were done slowly by our Fed on purpose. It's a little bit like putting a frog on a stove and slowly turning up the heat. The frog's not going to realize that. He's not going to even know that this is happening before it's too late. And so the Fed has approached our rate hikes in that way, not in a bad way. They just made a mistake back in 2008 of raising rates too quickly, and it ended up collapsing Bear Stearns and Lehman Brothers. And they didn't want to make that mistake again. And so they've been slowly raising rates, and it was very well telegraphed to anybody that was listening. And even with that, it did almost collapse a couple of banks. Signature Bank and Silicon Valley Bank, First Republic were notable earlier last year. But I think we've done a pretty good job of getting to a point now where we're going to have to wait and see what happens to rates from here. And recognizing that if we are in an uptrend, if this picture really throws us back not to 2008, but all the way back to 1968, then we're in an uptrend here that could blow off and lead to the thing that we all have in the back of our minds, the farm crisis of the 80s. So what we wanted to talk about today was just, are we right to say now's the time to be wait and see?
Yeah, Sam, I like the way you frame that with, we've had one game when it comes to interest rates in the last 40 years, and assuming that it is a new game, that we are seeing this shift. What's the new playbook? I think is maybe kind of how we need to think about that. And I know we're going to get into that a lot more on this call here, but I'm curious if you can maybe speak to that. If assuming that your arrow is predictive and not just reflective of where things have gone the last few years, what's the new playbook?
Well, yes, and I'm not making a prediction on either of those two red arrows, I do have an opinion, and I share the opinion with people here. So, but to say so publicly is maybe too bold. Let's talk a little bit about that. We've advanced the slide to this growth levers slide. The playbook cannot be, I'm out of the game for very long. Certainly, it makes sense to approach what you do in an expeditious manner. Kind of like in a military operation, you would fly sorties. You know, you fly out with a mission, you do what you got to do, you come back and you regroup. And then you fly another sortie tomorrow, and then you fly another one the next day, and kind of in an expeditious approach to what we do. And that's a good strategic approach to any of these things. So it may be that we do take a breather here for 1 year, but we're not taking ourselves out of the game. We're going to compete good markets and bad. It's not like we haven't just lived through this 8 years ago, or going back a little bit further, multiple times in the last 50 years. When you think about these growth levers, I just want to walk through this and maybe then give Grant a chance to speak to it a little bit. A lot of the answer to the question that was asked has to do with your current balance sheet health. So this is why I say it's really important for people to be doing two things. One is to be mapping out that profitability picture for the next year or two, and also making sure you have a really good handle on where you're at in terms of the strength of your balance sheet. One of the things I see consistently is that people will get together in groups, farmers will get together in groups and talk to each other, and they'll share ideas, and they'll talk about how many acres they farm and how many people they have and how many pieces of this particular type of equipment and how many of that, how many combines or whatever, and not ever share that one of those farmers is sitting on $20 million net worth and the other sitting on a $3 million net worth. And so the strength of your balance sheet, more than anything else, is what dictates your ability to be aggressive. So let's just say you have a whole bunch of dry powder. You have working capital in abundance. You 10 times your revenue or 3 times your revenue. Well, you do have some levers to pull. Now, it's important in this picture as we kind of walk across, and for those of you that aren't seeing the screen, we're looking at a screen here that shows 3 levers that can be pulled in this decision about capital or finance, capital expenditure. One is just cash, working capital, liquidity. So that would be better understood as current equity, especially then when you go to our middle leg, which is just the equity in the business. Conceptually, working capital is part of your equity. So this would be the equity other than working capital. That would be the equity that's in your fixed assets. That would be your non-current equity. So the equity in your land, the equity in your equipment, the equity in your buildings. And that you can tap easily with some sort of a loan. And then the third leg here is debt service, which, to make sense of that, I think you really got to think of that as how much is the operation producing? What's the profit coming out of the operation that would then help fund things that I need to do, like pay down my debt, buy new equipment, build my liquidity, those types of things. So any answer to how you move forward in this market is predicated on the strength of these 3 items.
Sam,
I can't answer that till I know. Go ahead, Shay.
With the clients that you work with, I would say from our experience, about 40% are sitting with that dry powder ready to go, that have the ability to leverage, to pull these levers moving forward. A lot of them are getting smoked on short-term debt repayment right now as a result of recent equipment purchases, which we usually see in these cycles. What's your perspective on, how many growers out there as a rough percentage probably have the ability to pull this lever and think about growth in an economic downturn?
Shay, I'd love to field that one here, just because coming out of this environment, 2022 was maybe the largest profitability we've seen from a farming operation standpoint, and it built that huge amount of working capital cash that you're alluding to right now. And 2023 was really rough. on these operators. So average operation, I mean, you could be talking 800 acres to 6,000 acres. Guys lost between $200,000 and $600,000 worth of working capital on average, most likely out there. And so there was a huge loss in that buildup of cash, those cash reserves, that dry powder to go and pull the trigger on this. And when we talk about $600,000 worth of losses, now let's talk about where that comes from a working capital loss standpoint. You know, half of that is probably just the change in commodity prices. Maybe you didn't grow as strong of a yield, and now we have $6 corn on last year's balance sheet that was sold for $4. Now we have $4 corn on this year's balance sheet. That's half of that working capital loss. And then you allude to the fact that, you know, we had a lot of cash to go make equipment upgrades, maybe put tile in the field, maybe change a pivot motor to electric, something of that. There were improvements made with that cash. And as Sam alluded to, at those high interest rates, you know, people that were paying attention, they might have avoided putting that on a loan. You know, they used that dry powder to make some of those improvements and not cut into their debt service or make margins tighter. And that could have been, you know, the other $250,000 worth of working capital loss could have been improvements by cash. And so there is still plenty of dry powder out there, I would say, to go ahead and make some purchases. But we chewed through a lot, and as the chart for commodity prices showed, we haven't found the bottom yet either. So there's room to move working capital to the lower right now, which is why we're having this panel conversation right now, is how do we manage that risk from a working capital loss and move forward into a growing pattern.
And Grant, I know you are focused in Nebraska, and Sam, you're in Illinois, and I know work with growers all over. But are you seeing kind of the same thing with what Grant just shared?
Absolutely. Remember, in ag, we mark our balance sheets to market, and we do that not only on your current, which you would expect, your inventories, your finished good inventory, for example, but also we do that on our fixed assets. So not only do you see shrink, so to speak, on your working capital, there's also this potential for a shrink on your non-current equity. Remember, working capital is current equity, and the rest of it would be your non-current equity. You also see shrink there. And in fact, that's what got us in the 80s, was that all of a sudden land had a 40-50% haircut, and gently used equipment saw the same sort of an impact. So one of the things that we have to do before we make a decision to continue to be aggressive with capital expenditure is we have to understand the strength of our balance sheet. I guarantee you that there are people with the strength on their balance sheets to be taking advantage of opportunity today. Now, coming out of 22, that was the best year we had seen since 12. And that there's a message there. It says something about our industry when 22 takes out the previous high. And I don't mean on percentage term, I mean on dollar terms. So even with inflation, probably if you were to adjust for inflation, 2012's performance was better than 2022's performance. But we also had massive stimulus-driven inflation in land valuation. And so the balance sheets from our perspective, and again, that's all across North America, was that 22 farmers are in the strongest position that I've ever seen. This is good news for us all, because that means the market for gently used equipment is going to have some support, and the market for farmland is going to have some support. What we don't want is a situation where there's no demand for gently used equipment, where there is no demand for farmland, because I guarantee you the supply is there. If demand collapses, then the price collapses. And that's what got us in the 80s. So some of your equity has to be reserved for that potential. Do I see it happening as bad as the 80s? Not in the next couple of years, for sure, because farms are really strong coming into this down cycle.
Yeah. Well, along similar lines, and Shay, this might be a good chance to bring you in here. There's a question from the audience. What are you all seeing on a working capital number at the end of 23 around the country? Are most sitting on 3 times revenue? More?
I would say that 40% that I used are the ones that have the dry powder and the ability to really leverage opportunities moving forward. And that's what I would pose to the group as well of that's my rough estimate, because those other 40 to 60% of folks were the ones that did make that short term equipment adjustments that they needed to after they've waited 5, 7 years through the economic downturn. I'm not saying that people with strong balance sheets don't have the ability to make that, but as far as a cash position and as far as thinking about their capital burn rate moving through the years ahead, 40% is my number.
Yeah, and I like to look at that a little bit differently. I would agree the burn rate has been strong. When you think about where we moved from 2014 to 2019, we might have had a working capital per acre is how I like to look at it a lot. We might have been at $500 of working capital per farmed acre in 2014. And in a lot of instances, that shrunk to $200 of working capital per acre, $100 of working capital per acre over the next 3 to 4 years, to where we really had tight margins. Working capital was not sufficient to cover the risk of farming the operation. We didn't have enough of a buildup of cash there from a short-term reserve. And coming out of 2022, as Sam had mentioned, maybe the most profitable ever, we might have been built up to $600-700 of working capital per acre for some of these operations. Now that very likely has shrunk to maybe closer to $450-400 of working capital per acre. So we saw a huge loss in that regard for a lot of these operations, but we also pulled a lot of price out of the market during that time. So hopefully the lows don't go too much lower from a commodity price standpoint, and we can better manage our working capital through factors that we can control, Shay, from a debt service, a profitability standpoint, how we're making management decisions. Hopefully that's a little bit more in our control of controlling the working capital now as opposed to the commodity markets.
Yeah, say more about that, because that's what I really want to get into here is like kind of the so what, right? Because we've heard some data points so far that make you really uncomfortable, others that make you think, okay, well, we're not necessarily headed for the 80s inevitably at this point. How are those conversations looking, Grant? I know you've been having with farmers as far as planning for this year and beyond. What do we do with this information when it comes to actual financial planning?
Well, Sam had mentioned it earlier. You have to make sure you're marking your balance sheet to market. You want to have a good understanding of where your position is, and you want to be working with your financial professionals to make a plan and be prepared to grow if your balance sheet, if your financials, and if your cash flow allows. And I think Shay's going to get into that a little bit here, a little bit more as far as, how are you going to approach these next couple of years? What are you going to be doing here to grow? If you are in a position to grow, how are you going to manage that? Come up with the plan with your lenders and make sure that you're in a solid position and you feel comfortable with your position and have a plan going forward. And that can be a 1-year plan, but you also want to have a 3-year plan, a 5-year plan, a 7-year plan. Know which direction you're heading towards. Have goals for your operation, working capital growth goals for your operation, and acre goals for your operation. Really set yourself up for success.
And your plan moving forward should not be here in your head. Write it down, put a presentation together.
Absolutely.
Take this format, what Grant and Sam are talking about. What is your working capital per acre? What is your capital expenditure plan? What is your capital burn rate? And that's a serious conversation that you need to have with the lender of, especially if you're in a position where you have an opportunity to grow, but you might not be as strong financially as what you would like to be. Sit down and map out over 3 years. Okay, what is my capital burn rate? What is the bank okay with? How do we kind of work through these scenarios? Be more methodical and diligent, because these are the opportunities after these economic downturns when we see operations grow pretty rapidly.
Well, and that's what's going to happen to people. They're going to get a call from some landlord, some piece of property that they farmed for 30 years, and hear that, hey, we want out. Aunt Millie has died, and this farm is going to go to auction. Do you want to buy it, or do you want to lose it? And so you're going to get forced into these decisions. And if this downturn lasts for several years, you're going to be forced into some equipment decisions because eventually depreciating equipment has to be replaced. So this becomes very strategic in terms of how you decide what you're willing to sacrifice. In many ways, we're coming off a period of time where the most aggressive interpretation of the law, so to speak, was rewarded. In a capital intensive business, in a period where money was essentially free, go for it. And those guys that did were rewarded handsomely. I wish I would have bought land in 2018 because it's up nicely. And I would have had it locked in at a nice low rate, and it would have already maybe 50% equity in it. That's not where we're at now.
Yeah.
This interest rate is different. And so it's going to do this thing that none of us want, because we like to shoot from the hip and we like to wheel and deal. This is actually going to force us to do a thing called discipline. Right. You know how that is, watching what you eat, reading your Bible, taking time to invest in your health with exercise. Nobody wants to do those things. Budgeting, capital planning. It's the kind of environment where you have to do those things. It's not the same environment as it was. That does not mean that there's no opportunity. Quite the contrary. It means that there is opportunity. It's not like dad and grandpa and great grandpa, in my case, great grandpa, dealt with different environments. And so we're encouraging people to go ahead and build those relationships with whomever it is and start that planning discussion.
All right. So I think we might be going to the same place, Shay, actually, because I think I want to pause right there to bring some perspective, because what you said, Sam, was both on a defensive side of like, hey, we need to make sure we do the basics and get them right and prepare for unexpected risks, but also on the offensive side, we need to prepare for unexpected opportunities, right? And just because there are some headwinds that maybe we weren't experiencing in 2018, but we are today, doesn't mean the right answer necessarily is to sit on your hands or bury your head in the sand and hope it just passes quickly. And Shay, I apologize for cutting you off, but I know this is something you speak to very well. How do we manage risk but grow strategically in this environment? And I want to give you a chance to maybe talk to that specifically.
Yeah. Harrison, if you can throw those slides up. So one thing that I would say, I like your scenario there, Sam, that you affectionately termed the Aunt Millie scenario. And Ben and I have talked about this on podcasts before. The opportunity that I want the listeners to think about is very rarely moving forward is it going to be 60, 80, 100-acre parcels. If you look at some of the land sales recently, it's 200, 400, 600, 1,000 acres at a time. And part of the conversation here is just how do we plan for the growth and the economic downturn? And obviously, Ben will talk at the end here, just kind of like fractal agriculture's outlook. But what I would encourage the listeners to think about is, there's kind of three main reasons to take risk and to have this growth. And either there's a good opportunity, there's a cost advantage. And so I am like Sam, I don't have a crystal ball on where land prices are going to go, or if we're going to see a 20 or 30% haircut on anything. But if there's a cost advantage, that's a great opportunity for you to grow. And also just strategic positioning. So is there 100 acres that you can purchase that's next to, the rest of that section of a different landowner that you're already working with? And the people, those of you that are on this call, I would encourage you to think about which category you fit into. Are you the visionary of your operation? Are you the person that does the strategic thinking and planning? Or are you the risk taker, or a version of all three? I mean, those are the people that we see that are taking advantage of the opportunities. They see that it looks good on paper. They do what Grant and Sam are recommending. They really do a diligent dive into their numbers. And then they're making whether you like it or not, they're making a gut instinct on whether it's a good decision. And so having that financial backing is huge. Grant.
Shay, I want to give kind of a personal example so that maybe individuals can relate to this a little bit. So, I work with ag lending, but I grew up on a family farm and am a part of that farming operation. And I wanted to be more involved with the farming operation. And so I started renting farm ground in 2017, 2018, wanting to eventually buy and invest in the ground, and got myself eligible for FSA joint financing during those years. So it was a few years where margins were tight. Wasn't the ideal time to necessarily be breaking into farming, but I got myself prepared over those next few years. Going into 2020, I worked with a lot of producers, knew that things had turned around, the environment was on the upswing, and managed to buy myself a farm that year, actually at the end of 2020. So it was a fixer-upper farm. It was 41 acres farmed with a creek winding through. It was kind of crap ground. We cleaned it up. We got the farm looking a little bit better, and I actually flipped that 41 farmable acres. I turned it into 47 farmable acres, flipped it 2 years later into a 112-acre farm. Because the timing was right. I prepared myself 5 years sooner to flip that and get over 100 acres farm into my own personal operation. And so when you talk about strategically planning for something like that, strategically locating yourself in a position to grow, that's kind of what it can look like for you. That's just my personal real life example of how I used a springboard of a good timing to really grow my operation. And actually, when I did the 1031 exchange for my creek bottom, 110 acres, I actually pulled cash out of that because we had equity growth. We used some creative financing, and really benefited me personally. I improved my working capital by adding acres. So work with your lender, work with professionals, find these opportunities because they're going to be out there again.
Sam, you mentioned you wish you'd bought more land in 2018, and for Grant, I guess we're similar ages. I saw this picture the other day of a 2-year-old napping, and it said, "Here I was sleeping when I should have been buying land." And it's kind of funny looking back. Obviously, that hindsight is 2020. Harrison, if you could go through the next 2 slides real quick, just to continue to follow up on the points here. So from the strategic outlook of when does that expansion occur? I don't know if we're at the low of corn. I don't do anything on the marketing side or try and make predictions here. But the chart that Sam had up looks like, we're in those lower time periods. Just how long is it going to last? The expansion is what occurs on the back end. And when you look at that growth over time, I would argue that maybe those peaks and valleys are a little bit steeper. How you had it adjusted there for that percentage change. That growth is actually going to be way rapid, more rapid, and might be a way steeper outlook that continues to shrink and swell over a period of time. That's just one consideration there. And if you go to the next slide here, Harrison. Okay, so looking at this growth trajectory, we kind of refer to it as the rocket ship example. Over the last call it 10 years, what we saw when we hit that economic downturn in 13 and 14 off the highs, 15, 16, 17, 18, and 19 were pretty ugly. Without some government payment injections and insurance, we would have been at or below the market for that 5 years. But then what happened, we started getting in these facilitation programs. We had the pandemic, we had the war, all that stuff. The operations that had built that platform and been strategic on their planning. And again, this is the business planning that we're talking about here. They've absolutely launched in the last 4 years. And I would say they're the operations that have grown, and they're the ones that have the strong working capital position. So think about that for your operation in the next 10 years. If it is a 5-year wave, or maybe it's 3 years, I don't know. Are you building that right foundation to have the growth long term? And maybe where I would kind of bring this full circle to my prior point is sitting across, and I'd love Grant and Sam's take on this. We've actually gone to our lender with our the balance sheet, cash flow projections, capital expenditure plan, and looking at what our capital burn rate is. And we actually preemptively said, what's our limit if we have a land opportunity come up? So how many dollars worth of lending are you willing to take on for us? So I think a good opportunity for those on this call is to ask what your input providers can do for you. If you put together that information, you go to them, have a plan in place, and then it's not a question. You might call before you go to the sale, would probably be advised, but you've had that discussion, you've been prepared so that when that opportunity presents itself, you can take advantage of it. So I don't know if you guys have any thoughts on that.
Yeah, Shay, I have two thoughts on that. Just going back to your rocket ship example real quick here. From 2000, let's say 2015 to 2019, we might have saw a large, maybe a 2,000 acre operation grow from a net worth of 5 million to 6 million over those 5 years. In 2020, 21, and 22, those operations exploded with a net worth from maybe 6 million to 10 million. So when you talk about preparing for what's to come and setting yourself up to take advantage, those operations did that, and that's what that looks like. Second thought there, just as far as preparing, I have a producer who's very forward thinking, knows his numbers very well, and that's the thing. It's the individuals that know their numbers the best typically are always prepared to pull the trigger on this. So they have their own, Excel cash flow spreadsheet. They know what their break even is, their pricing inputs to try to create as much profitability as possible. But producer, had a plan in place, knew where his position was, that he was able to buy ground that year. And actually there's ground that came up for sale in the section of his headquarters. And they put a post up for sale by owner, and he had that bought within an hour. And when producer asked him, like, how did you do that so quickly? He said, I've been waiting for that ground to come up for years, and I knew what I was going to offer them if it came up for sale. And he had that thing bought within an hour. He had talked with me, on that transaction. We knew going into it that he could buy, this here, here's your parameters. This is what the financing looks like. We had talked about just, any type of land purchase a month before that. So when this one came up, he didn't have to call me. He called them, pulled the trigger, and was ready to go.
And Sam, were you going to weigh in on that as well?
Yeah, I mean, I don't know where people are at. I mean, at some point, you can't win a game that you're not in. So, whatever it is, put yourself back in high school. If you want to win, you actually have to be on the court. You have to be competing. Mm-hmm. So that to me is pretty obvious, and I hope that most of the people that would take the time to join this call are already there. Look, I want to compete. What I'm trying to do is how do you make something out of nothing? How do I come with where I'm at and beat the system? And this is where you find sometimes people do the craziest Hail Mary plays and it actually works. Sometimes the underdog makes the stupidest move and it actually works. Sometimes you don't do the right thing and you get lucky. And who knew that COVID was going to happen? And who knew that we were going to dump $7 trillion into a $21 trillion economy? And that we were going to all of a sudden see land valuations go up 17% in 1 year. Who knew that? And so you call that strategy, or do you call that lucky timing? I don't know. So, but one thing I do know is that the early bird gets the word, a stitch in time saves nine. All those historic things that your grandmother taught you are actually good practice. And so you should be doing all of those. But in the end, if you've got nothing to lose, then go for it. There are some people that have a lot to lose, and so they're hesitant. And so how do you take the emotion and make it where you know that you're okay? Well, then you have to think about what could go wrong. So that's what I like to do with people as I'm talking through them is let's just bound that. Let's get our arms around the worst case scenario. And if you are willing to do that, the worst case scenario, and there's money left, then what are you afraid of? Get to work, get on it. Right. Other people might say there's not any money left, but I don't know that we're going to have the worst case scenario in the next 5 years that would be 1983-ish. Okay, let's put a number on that. So if you're struggling with the emotional side of this, I've found that the math actually can help you get beyond the emotion.
Yeah. Yeah, as can a plan. And I know, Shay, I think on the next slide, you've got kind of a set of questions to help guide folks through some planning?
These are just some of my parting thoughts. One thing from having the conversations with people around you, how fast would you ask people for something, or ask for the sale, or ask, to be a partner in their land operation long term? How quickly would you ask if you knew it would take you 26 no's to get a yes? And so just being in the game, like Sam just said, you have to play the game to win. You have to be a part of it. Because to Grant's example, if you don't have a strategic plan in place, lovingly to everybody on this call, there's someone with more money than you out there. I mean, that's just a general rule of thumb. Ben can attest to that probably. There's someone with more money out there that isn't going to have the emotional response. They're just going to say that's a good buy, and they're going to get it done. So having that strategic plan in place. The second question here is maybe a little bit sarcastic, but what are you going to do? Are you not going to grow for the next 5 years? And maybe you are. Maybe you're going to sit tight, like to those of you that answer the poll that way. But generally speaking, if you're not growing in this industry, or if you look at the people that have chosen not to grow over the last 8 years, they're probably feeling like they've been left behind a little bit. And are you positioned well enough to take advantage of new opportunities? And then just deciding, are you the strategic thinker? Are you the visionary in your operation? Or are you the risk taker, or some combination of all three? The question I like to ask operations, especially for leaders, probably the people on this call, if you're not the one making that decision, who is in your operation? If it's not you, then who? And there has to be someone that takes lead and has that vision for the operation, has a clear plan in place. And then my final thought here, Tim, is these waves happen. People call them cycles. I think cycles are a little bit more predictable. So I like to think of it as a wave. You get this high, and then it comes crashing down. How many of these do you get in a career? And Sam, there's been maybe 3 or 4 of these since the 80s. As people go through their careers, how many opportunities do you get to take advantage of this growth on the back end? And how does that look for your farm operation? So hopefully just some good thoughts for you guys to kind of take away and think about how do you take advantage of this over the next few years.
Those are great. It's super practical, Shay. Thank you for those. That really ties it in well. Well, I want to bring Ben in here. You summoned Ben in your answer, and we haven't had a chance to bring Ben into the conversation yet. But I do want to tell everybody this is your last 15 minutes to ask a question. So if you have been sitting on anything, hoping we get to it, don't sit any longer. Go ahead and ask the question in the Q&A now. But Ben, we have one from the audience that is probably a good segue to bring you in here, which is, what would be the best way in this environment to purchase ground? Well, the question, I'll read it word for word. What would be the best way in this environment to purchase ground with no money down to save cash?
Everyone's expecting me to say fractal, but that's not actually my first answer on that. First answer actually comes from something I've heard from both Grant and Shay. So if it's Aunt Millie, it's having that sometimes uncomfortable conversation ahead of time, having your list of landlords and that being part of your engagement plan. So that way you're preserving that working capital and that investable capital for the next opportunity and the next one, because it's coming. I think we have seen a disproportionate amount of off-market sales when we're underwriting, we're looking at comparable sales. A lot of people, we've had conversations with farmers, and they're saying, well, land's not selling. We show them all the comps. And they're like, wait, really? Is that happening? And I don't think people understand the combination of this margin environment that we've heard from all three of these gentlemen, and generational transition ever at this level. And so there will be more investable opportunities than not. And so you need to protect. That has nothing to do with fractal. That's just managing your land base as well as possible, on top of good grain marketing, good risk management, and just good margin structure, so you have as much investable capital. Then, do you have any other partners that are already available? So going ahead and working with that banker. So maybe you are able to just do a refinance, especially if you're able to refinance in a way that preserves great rates that you probably had from that lower cycle that Sam talked about before. Make sure you're talking about that with your banker, so you understand the flexibility you have on that capital right away. And if you've exhausted those two, hopefully, you have your rich dentist friend or whoever that is, who, you can trust with and who helps you buy land already. But, usually that gets tapped out or you don't have enough. And that's when you need to start thinking about, are there other creative financing mechanisms? Still not going to talk about fractal. Grant had a tweet a couple of weeks ago, I think, about it was either Grant and Clint Fisher about creative financing from a seller. You have a retiring farmer, and we're going to see even more of those. Can you get some type of seller-based financing, cash for deed? Are there other flexible options to, again, preserve capital? I know all of this is easy to say in a podcast and easy to hear. I think it's like building that plan, knowing your playbook and those different options. And when you have those, then explore, is there another option to bring in other sources of equity capital? And that's what we built at Fractal. And so our goal in here is, in the case of that question is, let's say you have debt and you have a banker that maybe doesn't want to let you refinance, but you have quite a bit of equity in a couple of fields you have. We'll go in, we'll invest a minority share in there. You can pull that equity out to get that down payment. You're still going to use debt. You're still going to go to a banker like Grant on that net new field. You're able to keep control of that field agronomically. You're able to participate in the upside of that field, of that new field, and the field that you worked with us on. And you're able to do that without just taking all of your working capital, putting that just cash position at risk, and risking what is both the financial and personal legacy of what are operations that need to be thinking on those long-term horizons. So for us, it's just it's another source of capital. We're not a silver bullet. Everything that these three guys already said, you have to be doing those for it to work with Fractal. But it's something that can allow you to scale and kind of take, if today you can grow by 100 acres or 50 acres, you might be able to grow by 150 or 100 versus that within it.
So Ben, I got one comment on that. And again, Sam, I really liked your analogy. You gotta participate to play the game. And so whether it's Fractal or just understanding the investor environment out there, or some of these high cash rents that you're dealing with, in some cases you got to pay to play, and you got to figure out opportunities to expand. So if there's a resistance to it, I would just encourage you to think again, are you the risk taker? Are you the visionary? And if you're not the one in your operation that's going to try to reach out and see if these opportunities are a fit for you, then who is?
And I do want to continue to go on that sequence there. When we look at Shay's questions that he had posed, are you not going to grow in the next 5 years? That doesn't necessarily have to mean that you're buying ground. Yes, it'd be great to find something small to position yourself well, but that can be talking to landlords, finding rental acres, finding a new income source for your operations so that you have the profitability to keep your balance sheet strong, generate the working capital to buy something when we hit the upswing. So growth does not have to be adding acres to purchase. It can be. That's definitely an ideal way to do it, because when you buy ground, you have debt pay down, you have appreciation, you have the profits off of that ground. There's a lot of ways you can grow within buying ground, but that's not the only way to do it. So there's a lot of ways that you can grow your operation and get better over the next 5 years or however long the cycle takes.
Absolutely.
Yeah, that really raises some of the challenges of the next level of discussion, which you really can't get as deep as you need in 1 hour. Now we're talking about what assets do you buy, whether or not you need to own them. Does it make sense to lease them or to rent them in some way? Can I, how much liquidity do I really need? What could go wrong? And I think that there's answers to these questions, but you have to have another hour of discussion to really break into this feeling about, do I need to leverage existing equity to get into this next piece of property? And I just want to say a couple things that we've learned from our experience is that there aren't really economies of scale to be had in production agriculture. And a good way to think of this for everybody on the call, your suppliers are 4,000 times your size. Your customers are 4,000 times bigger than you are. You do not exert pricing authority in the market. And understanding that adding another 160 acres means you're still small, and everybody on the call is small, just because your suppliers are $20 billion companies, $25 billion companies, not 5 million, 10 million, $50 million companies. So managing the risk is a real thing. And the 80s were a real thing. And good farms were taken out in the 80s. People that had made all their loan payments got a call from the bank and said, you have to pay this thing off at the end of the year. I don't think that the 80s are going to repeat in the same pattern, but that impact of devaluation of your assets only affects your equity. And the bank's not going to lose money on you. They'll liquidate you before they lose money on you. So these things are not about your gut. These things are about math. And we got to work through the numbers so that you know. And it makes a whole lot more sense to work through the numbers before the opportunity than it does after the opportunity.
Yeah. I think that's well said, and I think that puts a good emphasis on a lot of what we've talked about. And I think you've named our next webinar, so that's helpful too. But Ben, early we gave you a chance to give kind of a high level overview of Fractal. But if somebody's sitting on here and they're a farmer and hearing about it for the first time, from a farmer perspective, how is this working for the farms that you're working with currently?
Yeah, I mean, what we're seeing is it's usually a combination of either, it's a landlord where, they're getting the first bite at the apple on a landlord who's selling. Usually it's an off-market deal. It's a good deal. They have to do that deal to preserve their acreage. Because Sam, I'd actually disagree. Like there is a clear benefit to scale, which is you lose 400 acres in a 4,000 acre operation. Your fixed costs are staying relatively the same. You just lost 10% of your operating base. Your net margin went down. And like that is a big deal. And you see that impact. And like we've had some farms that have come to us and sadly they came to us a little too late. And like that is a really bad situation. Those are the worst calls that we have. So first one, preservation of acres that they have. Next one, opportunistic growth. They know that they want to take advantage of really unique opportunities that might, fill out a section. So now they're able to farm that whole section more efficiently. They're decreasing their operating radius. They're increasing that kind of operational effectiveness. So they might be trading a little bit of land, but at the end of the day, they want to preserve the cheap debt that they have on their field. They need to make that purchase from an operational and kind of like their growth plan. And it's even more acute when you're bringing that next generation on. And so all of a sudden we start to become entwined as a tool in transition planning and generational succession. And then, the last area that I probably wouldn't have imagined when we were first starting the company, but now is just completely self-evident and makes sense. We had one of Shay's folks who they were using us. They were incredibly disciplined operators agronomically and financially. They knew that they had some really good opportunities to improve fields with tile. And they knew that they can improve their margin structure, high ROI, and they didn't want to put their balance sheet at risk. So we did a deal, and I laughed. They probably arbitraged us if you really think about it in multiple ways. When they took our capital, they paid down some operating debt to start. Then they used it when they had a project that came in. I think the cool thing about building any product in agriculture is that farmers will find a way to turn it into 3 different things, and you kind of just got to roll with it as long as we're staying true to the discipline that all 3 of these guys have talked about. We underwrite high, debt service coverage ratios. There has to be, good discipline on kind of your overall balance sheet picture. And we want to know kind of what the plan is. But it's, we have 2 types of customers right now. It's the person who has a big deal that they can't do without us, or it's the planner. And the planners, they're coming back for those deals. And they're the ones that frankly are best positioned, both to work with us and in general.
And Shay, you mentioned your group, and it sounds like you've maybe got some experience with Fractal from the farmer side of things, or at least farmers you interact with. What was your first impression, and what has been your experience?
I wouldn't be sitting here today if I didn't think that it was a good thing. And to preface, we're in no way tied to Fractal. I just think that what these guys are doing is a great opportunity for people that are sitting on this call, and a lot of farmers in general that are looking to grow in a major way. The conversations from growers that we have reached out to and said, hey, you may want to touch base with these guys, have been overwhelmingly positive. Maybe 1 or 2 situations where they were in a really tough yield environment that didn't make sense. Like Ben said, you got to stay true to your principles on what makes sense from Fractal's model. And not everybody's going to be a fit. And there are other options out there, and there are other in some instances, cheaper options for capital outlook. This is not for everyone. This is an opportunity for you to take advantage of growth moving forward. And so, we filled out the forms. We've had conversations. Our farm operation is going to leverage it moving forward. Personally, I guess that's my personal outtake on it.
No, I appreciate you being candid about that. That's really helpful information. Well, I want to give each of these guys a chance to give their number 1 takeaway from the webinar. But before we do have a poll, one more poll, which is about Fractal. So if you want to add Fractal to your financial toolbox, just all you need to do is say, yes, please contact me. It won't be some, random weird person. It'll be someone like Ben or someone on his team. I don't know if he does all those calls, but somebody will contact you. Just go ahead and fill that poll out. But collect your thoughts, gentlemen. I want one takeaway from today's session. And let's see, Grant, we'll start with you.
I appreciate that, Tim. In my field, what I see is the individuals that have a plan, are prepared and know their numbers the best. All the opportunities find them. So they're the action takers. They'll get 10 opportunities before their neighbor who isn't looking for the opportunity gets one. So have a plan in place, know your numbers, work with your lender to know when and where you can pull the trigger, and be conservative in this environment. Have a plan. Otherwise, the opportunities will never find you.
Awesome. Well said. Very succinct. Sam.
I think if you consolidate your balance sheet and you fairly value your assets, if you currently have less than 65% ownership of your business, then you need a plan that says, how am I going to get over the next few years to where I own 65% of this thing? And that will become a limiting factor. And anything more than that, then you are making a choice to take risk. And sometimes things break your way and the risks pay off, and sometimes they don't. And if that's something that you're willing to do, then go for it. But for those of you that are more conservative minded, I really think that 65% ownership of your business, when you really put it all together, is a good target. And if you're not there, you need to be planning on how to get there. And if you're above that, then you've got some room to do. I've looked at the fractal opportunity as well, and I'm positive on it. I think they've carved out a unique portion of the market space, and there really wasn't anybody else there. That doesn't mean that it works for everybody, but it really is a unique option and legitimate option for producers.
Great. And Shay?
To Sam's point, what are your options? As you look at growth, and kind of the basis for this conversation is, how do you grow in a tough economic environment? When you get off this call, write down a list. What are your options to grow? You can increase yield. You can work with an investor. You can use someone like Fractal. There might be a list of 7 or 8 things. Like Grant said, diversified income. Think about what your long-term strategy is. But that list is pretty narrow right now. And so are you leveraging the tools that you have available to you? And then finally, my parting comment is, the people that are on this call that are listening, if you're not doing it in your operation, who is? Take that ownership, embrace these opportunities, and be the strategic planner that your business needs you to be.
All right. That's like a clip for TikTok right there. Thank you, Shay. And Ben, we'll give you the final word here.
Yeah, I'd say, this is complex, but I mean, most people have done this before. So finding the right team to help you out. So, and you got 3 folks here who have great information, like your lender, finding outside advisors. Like, that is a key part of making sure that you're actually putting that rigorous plan together. And then I would say within that structure, understand the competitive framework that we're entering. I don't think people realize that this is going to be a very unique time in agriculture with generational transition. We've been talking about for 12, 15 years since, the 2012 ag census. Like, it's here, it's in the data, it's impacting operations. And the people who are not just ready, but the people who are creative, who are willing to be uncomfortable, to Shay's points about asking for no, and who are willing to learn and figure out and find other tools, whether it's us or somebody else. Just being starkly realistic about the competitive environment and what it's going to take for your operation to be where you want it to be in 10, 20, 30 years for you, your family, and your business partners. That realism is going to come to a head in a way that I don't think was true in the last 30. And hopefully we can help that be a more farmer-led future and not what's happened in other parts of our industry.
Thank you, Ben. Thank you all. We're going to do a follow-up email after this. Highly encourage you to provide your feedback on if this was valuable to you, what questions remain unanswered, and what you'd like to see in future webinars, or if you'd be interested in joining more like this. That wraps up our poll. That wraps up our session here today. Thank you very, very much. These are real issues, and it's great to have a forum where we can all hop on together and talk about these live. So thank you to our panelists very much, and we'll go ahead and close out today's session.